Hey folks, David Frost, My Strategic Forecast. You're here for another episode of Common Sense Market Analysis. Today is Monday, January 9, 2017. We're looking at a daily chart of the SPY or SPDR, which is, of course, the proxy for the S&P 500. Now, we had an interesting day today. The market really didn't go anywhere. It had a very narrow range day, but what you'll notice is where the close is. The close at 226.46 is back below, the 226.59 number. And what that does, at least temporarily, is it puts a halt on the upside for the time being because we did not confirm above that level. And what we really needed to see in order to continue higher is a close above Friday's high, which we did not see. In fact, the market struggled pretty markedly today, and that leads me to believe that we're probably going to see some more downside over the coming days. Of course, you'll have ups and downs, fits and starts, but what I can see happening is I can see us trading down into the inauguration if we can't muster any more upside from here, but that's a little bit early to make that call. I'm just giving you some thoughts that are on my mind, and I've mentioned that before, that I wouldn't be surprised to see us trade down into the inauguration and then make a turn. And conversely, if we trade up into the inauguration, I think it's also a good timing mechanism for a turn in the market. So in that week, next week, so the inauguration is next week, Martin Luther King Day is next week. So I believe that sometime next week, and what I'm referring to is the week of the 16th, I believe that should be a pivotal turning point for the market, at least to mark a short-term high or a short-term bottom, one way or the other. But it's too early to tell. So either we're going to continue higher, but we need to confirm above Friday's high in order to get that going, or we're just going to have a multi-day pullback, and if we do, that could be a pretty good scenario. If we pull back for a week or so, that could be a good scenario for some upside coming after that, in and around sometime the week of the 16th. So we'll see how it goes. Right now, I take today as a bearish signal. I'm not saying the market is bearish, just on a very short-term basis. I think today's activity was a bearish signal. And let me explain a couple of the other reasons why. First, let's go to the hourly chart in the SPDR. And I want to show you something else that happened today or didn't happen today. The second candle of the day, the second hour of the day, was up. And under normal conditions, with a very light volume, and the volume today on close was only 46 million shares in the SPDR. That's very, very light. It's, yes, a Monday, but very, very light volume. So generally speaking, in light volume like this, the market is going to be somewhat buoyant, and the path of least resistance is generally up. So when you look at the second candle of the day, the market had the SPDR had every opportunity earlier in the day today to come up and at least fill the gap that was left from Friday on the last candle of the day. So that gap that needed to be filled was at 227.24. So in that candle, in the second candle of the day, we made a high at 227.07. We had every opportunity to fill that gap, and they couldn't do it. That's a bearish signal, number one. There's another bearish signal, which is the bearish pattern that is now occurring on the hourly chart. So we had a down move from Friday to today, and we went sideways all day. That's a bearish wedge pattern or a bear flag pattern. Generally will promote lower prices to the downside. Let's look at, well, we're going to get to the IWM and the transports in a second anyway, but that's another two markets where we saw bearish behavior today. If we did by chance continue down tomorrow, where would we go on the downside? Well, this pattern, if it does complete, this bearish pattern, the completion of this pattern would be somewhere in between the the 50 moving average at 225.54 and probably somewhere below 226. So we'll call it 225.75 for argument's sake. And if you look at where that is, it just so happens that it's in this area where there's a lot of chart support. There's a lot of pivots around this number at 225 and 3/4 in that neighborhood. You can see over here. You can see here in this neighborhood here. The high of this day was 225.75. This happens to also be around a 382 retrace from a recent pivot low over here to a recent pivot high over here. So there's a lot of signals, or there's a lot of reasons why the market should find a level of support at around 225.75 or slightly below. Maybe it gets to the 50-period moving average. There's let me get rid of this. There's also a gap fill that would be at 225.18. So there's a lot of reasons why the spider would find support in and around that area. Of course, that's barring some other reason why we would have a wide open break tomorrow that we don't see coming, of course. The only thing that I can see that could jolt the market between now and tomorrow is I believe there's some economic data out of China, but I don't know whether that's going to impact the market or not. That's the only thing I can really see on the horizon that could potentially impact the market. Anything that we can't see, of course, would be by definition a surprise. So I think that about covers the spider. Let's go back to the daily chart and we'll head over to the IWM. And you can see here in the IWM, it was a weak day today, and it was weaker than the spider. The spider was down 1/3%, while the IWM was down almost 3/4%. And you can see that we're into somewhat of a critical level here that, if we break below these levels here, then there's going to be more downside in the IWM. So we're watching the IWM as a leading indicator of the market on both the up and the downside. The bigger picture is this is a bullish pattern, but the short-term picture is there's been pressure in the IWM for the last 3 sessions. We've been talking about it, and when you look at it and you say, well, is the IWM the canary in the coal mine? And it may very well be. It just may be a couple of days ahead of the other markets. So we just have to be aware of that. Weakness in the IWM is going to prevent upside in the major markets. That's just the way it is. The only market that was up today was the NASDAQ Composite, and that was only up about 11 points. And primarily on the back of some of the bigger tech names, Apple and various other names that were up. Amazon was up a little bit, Google was up a little bit, Netflix was flat, Apple was up. So when you look at those names, they carry a lot of weight in the index on the NASDAQ. Which is another reason why, while the NASDAQ is a decent proxy for a leading indicator in the market a lot of the time, I tend to shy away from it because it's so top heavy in some of the big tech names. The IWM is much more representative of a broader index. It's got 5,000 stocks 2,000 stocks in the Russell 2000 index. That is the tracker for the IWM, or reverse. So there's much more broad participation across the market in the IWM, and that's why I like to use it as a leading indicator. The other thing of note today is the transports, and the transports were weak today, and you can see us continuing the bearish pattern that we've been making now for over a week. Again, leading indication of the market. Now, if we look back a week ago and said, well, the transports are beginning to make a bearish consolidation pattern, you would have been hard-pressed to see that in the other markets because they were still going up. But all in all, remember when the transports closed below 91.42, I said the bullish pattern was off the table, and until further notice, that's not necessarily bearish for the market, but it's not bullish any longer. It's slightly takes the bullish case off the table, and you've seen us struggle to get back above that level, and you can now see the importance of that level at 91 42. We're making a consolidation pattern, and the transports are going to want to come down and test the 50-period moving average, which is also right around the 88.90, which is another important level. So we should see that happen in short order. And I think that barring a breakout tomorrow, I think these markets are going to sell off for a few days. And that's what all the different indices, that's what all these different technical aspects of all the charts we look at, that's what the evidence is pointing, at least in my view. Today, we might as well also look at the XBD, or the broker-dealer index. And you can see here we had flagged the high. Let's go over to the weekly chart. Oh, that's the monthly. Well, either way, it's the same level. Well, we can go to the monthly, and I'll show you where it came from. So 214.35 was a level that I said we would find a good level of resistance. It technically completed the ABC pattern, right? We had an A leg, B pullback, and C leg. That's technically complete. Doesn't mean we can't go higher, but it's technically complete. And it's also a 7.5 retrace from pivot high, using that, and pivot low. And this is a 7.5 retrace at 214.35. So there was every reason why the market should at least struggle to get through 214.35, and that's exactly what we're seeing. As soon as we hit that number, we saw the pullback, and if we consolidate for a while below that number, then the market or the broker-dealer index can build energy to go through, or maybe we pull back in a more of a deeper correction and then go higher. Either way, that level was very, very good for resistance to the broker-dealer index. So you can see on the daily chart, we hit it, pulled back, went up to it, couldn't get through again, a little bit of stall out. So if we consolidate in this area here, specifically above the 20-period moving average, then it will be building energy to get through. All right, let's go over to the gold market. Now, gold's doing the same thing today that it did the last couple of sessions. It found resistance slightly above the 1182.60 that I had pointed out. I guess the high today was 1186.40. The high from Thursday was 1185.90. So this is an important area. Of course, there's a major level of resistance around the 1200 area. It's a psychological round number, also coinciding with a 50-period moving average. But there's another number in between at 1190.20. That's this pivot high here. So if we can clear that, I think that's a first sign. If we can clear it on a daily closing basis, that's the first sign that there's more upside coming. If we continue to consolidate like we did today and Friday in this fashion here, another couple of 3 days like this, and then the upside is certainly in the cards. The market will have been, the gold market will have built some energy for another move higher. So that's where we stand now. But if we fail at these levels, then we're probably going to go back down and head toward potentially the 1160, 1152 area where this 20-period moving average is. So if the market fails at 1190 and can't get through that zone, then I think we're going to have a down leg in gold. But ultimately, if we can muster the upside, if we can get through some of these levels, then 1220, 1225 is in the cards. And that was really the last breakdown point at 12 1/4. You can see here this consolidation. And after that, we really started, just in a perpetual downtrend all the way down. That number or that level should be tested once again, but it's not going to be easy to get all the way up there. The first order of business is 1190.20. And those are the numbers in gold. I did a considerable amount of work in gold over the weekend, so I've got these numbers that continuously come up over and over again, and we're going to use those to lean on. Looking over at the silver market, same story in silver. We're consolidating sideways. It's really much of the same story. Another move higher will bring us into the 50-period moving average, and all of this this consolidation here is going to be resistant to the market also. So even though we're consolidating, the next leg up is generally going to take us into around that 17, maybe 17 and a quarter area, and the market should find, silver should find a fair amount of resistance at that point. If we can bust through, then the next area would be 18 or the 200 period moving average. Next up on the docket will be crude oil. And crude oil took a pretty good hit today. And you can see here that the bearish pattern that developed over the last 3 days played out. And you can see this market symmetry at its finest. We had the down move from up over 55. And we had a bearish wedge pattern and then another down move. And this is market symmetry. And what that did was it put crude oil in somewhat of a, or not somewhat, in a weaker position, specifically getting below $52 a barrel. So the next area on the downside, the next natural area is going to be 51.50 and then 51. If 51 doesn't hold, then we go down to 49. And that's the way I read crude oil. So this is, while this is a bullish pattern in the upper range here, it's now coming into question as we're starting to see some damage done to the crude oil chart. When you have big down days like this, it generally tells you more downside is coming. All in all, there's no pattern to trade. There's no trade on the long side, no trade on the short side. We'll wait for the chart to tell us what the next likely scenario is. And while certainly the bearish pattern out of the last 3 days, Wednesday, Thursday, Friday of last week, was a bearish pattern, and some traders may have taken that playing for the downside. I didn't like it because we were in a longer-term uptrend, being above all the moving averages in crude oil. It was not a high percentage trade by any means, even though the symmetry of the market played out and the bearish wedge pattern played out. The percentages of, or the probabilities, I should say, were not necessarily what I would have liked to see for a trade. So when I don't see the probabilities in my favor, I just leave it alone. And hence, we're just going to wait for crude oil to find a decent area or level of support for the market. And then we'll take a look and see how it came into it. 49, I would take a look. 49, 48, I would certainly take a look at crude. But before that, I'm not 100% sure. We'd have to see exactly how it might come into one of these levels up here, 51 or even $50. But 49, I think, would be a real good opportunity for a long play in crude. And just real simply, in between 49 and 48 is your 50% and 618 retrace. You have moving averages. There's just a ton of support in that area. So based on how crude may come into that area, we might be looking for a long trade, whether it's in crude itself or something else in the energy complex. For now, we'll just leave it alone. Let's head over to the bond market, where we saw a nice update today. Back into the 50-period moving average. Again, looks to be like it's making a bullish consolidation pattern. It's a little early to tell. We've only got 3 days up in this area where we're going sideways 2.5 days. But the more we go sideways, the more likely we are to build energy for a move higher. You can see where we are. We're into this area where there's a pivot high. There's a lot of chart resistance in this area. There's a lot of consolidation in this area. So it makes all the sense in the world that once we got back to that area, that the market would find resistance. Also with the 50-period moving average sloping into that area, it just makes common sense or logical sense that the market would find resistance up in this area. It's possible we get up into the 154.2 area, and if we do, that'll be another area of resistance. But if we got above there on a daily closing basis, then we may be cooking up on the upside for some more bullish behavior in the bond market. But up until that point, I just don't see a ton of upside. We may see an uptick in the bond market if we do see some downward pressure in the major stock indices, but we'll just have to wait and see. There's nothing to do here in the bond market today. Next up, on the dollar, we saw some downward pressure in the dollar today. What we're doing here is we seem to be making a bearish wedge pattern. So we never did get to the number. What was the high? 103.81. We didn't get to my 104, 105. We came close, but didn't get there. I still think we have more upside in the dollar. I haven't given up on the upside yet, but all in all, this is making a bearish wedge pattern. What this is telling me is that the dollar wants to come back down to test maybe below 100. Well, this pivot low down here is at 99.45, and 100 or par is over here. And so 100, a psychological number, and this pivot low slightly below that, the market would find or should find a fair amount of support at those levels. So if we continue in this bearish formation, they have no other option to think that we come down to test 199.50 in that neighborhood in the dollar. And with that, folks, I'm going to leave it there tonight. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.